Okay, welcome to our last section in Chapter 2 today, where we will be talking about specifically how transactions affect our owner's equity accounts. So we will be looking, each of the transactions that we have are going to affect owner's equity in some way. So we're going to talk about analyzing our transactions for operating a business into debit and credit parts. So what we are going to talk about now is specifically how things affect owner's equity. And one thing that particularly affects owner's equity is when we earn revenue as a business. So when we earn revenue, what we're talking about is us making a sale based on whatever it is that our business sells, whether it happens to be a service, which is what Delgado Web Services does. They design websites, so that's a service, or if they sell products. Okay, anytime we do that, anytime we sell our goods or services, we make money as a business. And the place that that gets recorded is in our owner's equity accounts. So an increase from revenue, we could record it directly into our owner's capital account, our Michael Delgado Capital. However, sales happen very frequently, and so really as a business, we would want our own account to be able to keep track of those transactions. So we have created our own account. It's called Sales. Sales is the same thing as revenue. It is classified as an owner's equity account. And because it increases owner's equity, it actually increases on the credit side and decreases on the debit side, just like a normal owner's equity account would. So let's look at the transaction. It says that on January 10th, we received cash from sales of $1,100. So again, we're going to go back to our 4 questions and ask which of our accounts are affected. We have 2 accounts. One is cash and one is sales. Okay. Note that sales again is an owner's equity account. We aren't going to be keeping track of all of these in our capital account because that's just going to get to be too many transactions. So we want to keep them separate. So again, cash, sales. Secondly, we want to ask how is each account classified? We know that cash is an asset, so we have that classified. And then again, as we already stated, sales is a revenue account that affects owner's equity. So it falls under the owner's equity category. We need to think now, how is each account affected? It says that we received cash. That's a pretty good clue that cash is increasing. And then when we have sales, if we received cash from sales, that means we made a sale for our business, which means that sales is increasing. So again, owner's equity is also being increased. Then we ask ourselves, how do we record these? Is it as a debit or is it as a credit? So we know that cash is an asset, and since it's increasing, that means that cash is debited. And then we also have our new account sales. Sales is an owner's equity account. It's also increasing, which means that it increases with a credit. Okay, so we have a cash debit and a sales credit, both of $1,100. They're equal. We are happy as clams. All is right in the world. Now, to throw in a little bit of something tricky, when we talk about selling our services or our products, there's actually 2 ways that we can do that. Okay, the one we just did is that we sold something for cash. That's very typical. However, there are times when you have a transaction like that that doesn't affect cash, where we have people that receive a service from us and don't pay for it right away. Okay, we call that an accounts receivable. Okay, accounts receivable, as a business, we classify those as an asset because these are amounts that are going to be received in the future. If you think about this, this happens all of the time. If you think about your phone bill, if you think about your cable bill, if you think about going to the doctor, if you think about having any yard work or landscaping done, all of those things, you go to the doctor, you see the doctor, you don't pay for it that day. You pay for it 1 week, 2 weeks, 3 weeks, a month down the road. As a doctor, as the business, what they're doing is they're actually considering that an accounts receivable. They have performed the service for you, but you haven't paid for it yet. Okay? That's the same thing that we're talking about here. Eventually, we will be paid, so we classify that as an asset. Okay, accounts receivable, since it's an asset, increased with a debit, decreased with a credit. So that is another new account that we're looking at. So let's look at a transaction where it says we sold services on account. So here it says on January 12th that we sold services on account to Main Street Services. So again, we have these tricky words. And remember in the last section that I said when you see on account, that kind of triggers your brain that it either can be an accounts payable, which we worked with as liabilities, or it could be accounts receivable. You have to read the transaction carefully though. Are you the one that is paying as a business? And is it a liability, or did you do something where people owe you money? In this situation, because we sold the services, they came to our business, we performed some sort of website service for them, and they owe us $500, but they didn't pay for it that day. Okay, that means that we have an accounts receivable in play. So again, our first question is to ask which of our accounts are affected. Our first one is accounts receivable for Main Street Services. And then our second one is sales, okay? Because it says we sold. Sold is a key word for sales, okay? So we have accounts receivable and sales. Then we look at how each of those accounts are affected. Accounts receivable, again, is an asset. We just talked about that. It is technically listed right underneath cash in our chart of accounts, simply because we believe that we'll receive that amount relatively soon. And then, as we already stated, sales, of course, is a revenue account that affects owner's equity. So then we ask ourselves, are these increasing or are they decreasing? So the first one we'll look at is our accounts receivable. Accounts receivable is actually increasing, and the reason being is because those people have not paid us yet, so that accounts receivable is going up. They owe us money, okay? And then our sales, as we already said, if we sold services, that also means that it's increasing, so owner's equity is being increased. And then we ask ourselves, is that going to be a debit or a credit? Well, we know that assets, if they're increasing, get debited, so accounts receivable will be debited, and that sales is also increasing. That means that sales is going to be credited, okay? And so we have a debit to accounts receivable and a credit to sales, both of $500. Again, those are equal, so we are happy campers. Our next thing is to talk about paying cash for an expense. Now, what we need to remember is that expenses are costs of doing business. So anytime that we have to pay for something as a business, that we need to make sure that the business is running appropriately, that actually decreases our owner's capital account, okay? And so again, just like sales, we could record everything in our owner's capital account. However, these are another type of transaction that happen very frequently. So we really want to keep track of all of our expenses in their own accounts. So again, an expense is a cost of doing business. Technically, it's classified as an owner's equity account. And the tricky thing here, I want you to look at this. An expense actually increases with a debit and decreases with a credit. Now you're like, whoa, 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 whoa. Mrs. T, you said that owner's equity increases with a credit and decreases with a debit. Yes, I know. However, please note up here that it says an expense decreases owner's capital. So we need to do the opposite of it. Does that make sense? If owner's equity normally increases with a credit, if an expense decreases that, we need to increase it on the debit side because it's the opposite, okay? So as I said, because expenses decrease owner's equity, they get increased with a debit and decreased with a credit, okay? And that's just one of those things where you kind of have to remember it because without it, it's going to get tricky, okay? Again, the more you do it, the more it'll make sense. I know it's a little bit of backwards thinking right now. So let's take a look at this. It says we paid cash for an expense. On January 12th, we paid cash for communications bill for our cell phone and our internet service of $80. So you can see how that's a cost of doing business. In order to have your cell phone, in order to have internet, those things come out of your owner's capital account. So again, our first question we ask is which accounts are affected. Our two accounts are actually cash, and then we have communications expense, okay? And so we have identified cash and communications expense. Typically with your expenses, you have an account for each one, and you'll start to see this as you do transactions. You'll have advertising, you'll have repairs, you'll have rent. Each of those will have their own expense account. Our second question is to ask how each account is classified. We know that cash is an asset, and as we just stated, communications expense is an expense account that affects owner's equity. So technically, communications falls under owner's equity account. And now we have to ask ourselves, how is each account changed? Well, it says that we paid cash, so cash is decreasing, our asset is going down, and we created essentially a communications bill for ourselves, which means that that expense is going up. Okay, so our owner's equity is technically being decreased because expenses decrease owner's equity. But when we need to record that expense itself is actually increasing. And so our fourth question is to ask is, does each one get a debit or a credit? Well, we know that if cash is going down, that means that cash is credited. Hopefully we've got that kind of in our brain already. Cash is usually our easiest one. And then again, our toughie here is to think about the fact that communications expense is debited. And the reason it's debited is because communications expense is going up with a debit, and that means that that's technically decreasing owner's equity. Okay, so that's what they're talking about here with this little debit, means that it's decreasing owner's equity, when really the expense account gets increased with a debit. So if you look here, we've got a credit and a debit. They both equal $80, and so we are happy with that paying cash for an expense. Lastly, we need to talk about when we receive cash on account. This is for those people, if you remember, we sold services to Main Street Services, our accounts receivable account, and they had not paid us yet. Eventually, down the road, you can see it's probably about a week later, we received cash on account from Main Street Services for $200. So they are paying us the money that they owe. So let's look at the two accounts that are affected. Our first one obviously is going to be cash. Our second one is going to be accounts receivable. Now please take a look here, because how are both of these actually classified? If you look, both cash and accounts receivable are both assets, and that can totally happen. Remember, you can have a transaction on the same side of the accounting equation. We ask ourselves, how is each account changed? It says we received cash, so cash is going up. And then let's look at accounts receivable. What this means is that those people have paid us now, so they no longer owe us money. So that means that their accounts receivable is going down or being decreased, which then means, are they going to be debits or credit? Well, if our cash is going up or being increased, that means that cash is debited for $200, and accounts receivable is going down, which means it's being credited for our $200. And since both of those debits and credits equal each other at $200, we have a good transaction. Okay, I think again, just because I'm about to run out of time, let's meet over in our part 2, and we'll talk about doing something called a withdrawal.